Craig and Michelle. We're here to kind of touch on some fine points on PPP loan. We know quite a few of you have received loan proceeds already, or are about to get funded, or maybe considering getting funded. And Michelle's obviously our resident expert, but I thought it'd be good to help answer a lot of questions, put some things out there that we're seeing in the marketplace right now regarding the PPP loans, how you can receive forgiveness, how you can maximize it, and then how we can help and just keep you running your business the way you want it to. So with that ado, I am going to start sharing my screen and get us started. All right. So as you can see on our screen here, bear with me just a little bit as I get it so we're set up to just see the screen. Back to screen share, and there we go. Okay, so PPP loan is funded. Now what do we do? Here's our agenda for the day. First, we're going to cover just some of the high-level basics. We'll talk about some of the expense limitations, the wage and FTE reduction provisions that are in the loan program. We give you a quick, small example of it. We'll talk through kind of what happens to the amounts that are unforgiven. Talk through quite a few of the unknowns. We obviously see changes almost daily or weekly on provisions. Congress and the IRS are currently debating some important ones right now. We'll talk through next steps, and then we'll answer a few other questions as we move forward. So, Michelle, why don't you talk a little bit about the basics on what you're seeing?
Well, and just as a quick disclaimer, this is the information we have as of today. As Craig mentioned, it is changing all the time, so the best thing we can do is just to be prepared. So you received your PPP loan funds. That's great. You have 8 weeks to spend them from the date of funding. 75% of it must be spent on payroll, a minimum of that.
In order to qualify.
In order to qualify. We're only talking about loan forgiveness right now. Right. So a minimum of 75% must be spent on payroll. What does payroll include? It really includes about the same things, from what we understand, as what qualified for the PPP loan calculations. That includes gross wages, state unemployment tax, employer paid health insurance, and 401k match. From what we understand, that also includes bonuses and commissions as part of gross wages. The remaining 25%, if you happen to have anything left over, can be spent on qualified expenses, which include rent, utilities, telephone, internet, mortgage interest. The one caveat of that is your rent, the utilities, and your mortgage had to be in place on February 15th.
Next slide.
So what does this look like? We're going to use a $100,000 loan example in this. Let's say you had $75,000 of qualified payroll expense. You can have $25,000 then of the other qualified expenses qualified. What you need to make sure you understand is if you only have $60,000 of qualifying payroll expenses, your qualified expenses, rent, utilities, and all of that is lowered by the same percentage. So it'd be a 60-20 split. It's quite possible you may spend $110,000 in payroll. Well, then you can use all of it for your payroll and don't even need to worry about the qualified expenses. But we did want to make sure that you saw that your qualified expenses adjust based off of what your gross payroll expenses are.
Correct. And so if you have a $100,000 loan and you only have $60,000 of payroll, you don't get 25% of the full loan. You only get the percentage as it relates to that 75-25 percentage split based on the new current qualified wages.
Correct.
Yeah.
The same as when that you qualified for the PPP loan amount, as everybody's salaries were maxed out at $100,000. Same with what counts as qualified payroll expenses. So we kind of put together a really quick chart on here as to what that maximum amount looks like per period based off whether you're on a weekly, bi-weekly, or semi-monthly schedule. One thing to take a quick note of is if you're on a semi-monthly pay schedule, it is not the full $4,000. It's not a full 4 pay periods. It is a little bit less because it's calculated based off 8 weeks, not 2 months. So it's just something to kind of have in the back of your head.
Yeah, you basically take the full amount up to 100,000, divide it by 52, and multiply it times 8.
And that's your
and the other thing that's really important here is that you need to have these expenses be paid and incurred. We'll get to that in kind of some of the unknowns, because that is still one of the items that we're a little bit fuzzy, I guess, on. We need some industry guidance on that from the IRS and or Treasury regarding what that qualification of paid and incurred is really going to entail.
So another limitation, besides the $100,000 max, is also this wage reduction allowance. So we have a couple different examples here, but in order to qualify for the qualified payroll, you are not able to reduce, your loan forgiveness is reduced if you reduce an employee's wages above 25%. On a pro rata basis. So in this instance, Toby in the prior quarter made $12,500. That calculates an 8-week average of $7,692. However, during this 8-week covered period, you only paid him $5,000. Well, that's a 35% reduction to his typical salary. And so that excess of the 10% above the 25 is then calculated, and you're reduced by your loan forgiveness will be reduced dollar for dollar. That's $769.
Maybe Toby should have been a little nicer to Michael.
Maybe Toby should have been a little nicer. On the flip side, what you can see here is for anybody who's in that $100,000 or above category, it still isn't a bad idea to look at them. But Michael, for instance, you are not going to, even if he made $200,000, the maximum amount that this reduction is going to be calculated on is the $25,000, which is 1/4 of 100. And you just need to make sure that those people aren't going below the $75,000 or a 25% reduction.
And that's another item that's still in the unknown, is what happens with that person that was at, say, 110,000 and is now at 80, or even further down, 70, 60, something like that. They've been reduced more than 25%. There's a little bit of back and forth on whether, if you're over 100, do you even qualify for the 25% forgiveness or not. Reduction.
So we're trying to be conservative and kind of throwing this out there, just have it in the back of your head for those employees that are highly compensated.
The one thing you were just kind of hitting on too there is this FTE reduction. So it's not just a matter of total gross wages you pay. It also relates to how many people you have on staff.
Correct.
Can you talk a little bit about, walk through that?
So the whole point of the PPP loan program is to pay employees. And so one of the items that they want to make sure that you calculate is, what is an FTE? It's a full-time equivalent employee. So you first have to calculate your baseline FTE, and you get to take the lesser of your average full-time employees between February 15th of 2019 and June 30th of 2019, or the lesser of between January 1st, 2020 and February 29th of 2020. So you get to take the lower number of both of those averages.
So in this instance, if you had a situation where, say last year in that February through June period, you had 5 people on staff, and now, you had hired some people during the year and got up to 10, and then all of a sudden you got into a position where, everything hits and you go back down to 5 people, you're not going to be penalized on the number of people you had when the loan started, it's based on either the lesser of either of these two periods. So it actually can help in the calculation in the benefit of the taxpayer.
Absolutely. You also have to calculate your adjusted FTEs, and those are the average full-time employees during this 8-week covered period, or the number of employees, full-time employees you have as of June 30th. So what this does is it gives you an opportunity that if you did have to lay people off and furlough people during this time you're covered by the PPP loan, you have the opportunity to hire them back by June 30th and not be penalized for not being able to employ them during this time.
Yeah, and that's a huge point that we'll talk about here in this next example of the multiple different calculation opportunities you have.
So we have 4 different scenarios here. We're using a $100,000 loan as an example. In scenario 1, they had $65,000 of qualified payroll expense, which then limited their qualified expenses, rent, utilities, to this $21,000 number. So the total eligible forgiveness, you can see $86,000. However, they had to lay off 5 of their employees. They're only at a 15% retention factor, which then reduces those eligible forgiveness dollars by the 50%. You then would also take off the wage reduction. So these are people who were reduced below the 25% of their salary to get to actual debt forgiveness. However, if you can see in scenario 3, same exact scenario, however, they went back and they hired everybody back by June 30th. They all of a sudden get 100% of their qualifying loan forgiven. What we wanted to show in scenario 2 and 4 is they decided to hire 3 people back on day 1 of this 8-week period and ended up spending an additional $45,000, but it really only got them $36,000 of forgiveness. So while that may be the best business decision, you want to make the best decision for your business. Don't do it simply for loan forgiveness.
Right, and I think it shows that there are a couple different options. So the key here will be getting through and being able to determine this over the next 8 weeks through June, and then through June 30th, so that you can, at this point, be able to figure out, okay, if I spend X, what's this going to help, and figure it out. It gives us a number of options, and I think that's going to be key. The one thing that we'll talk about a little bit here further on in some of the other examples is what happens with like a Schedule C person and how they calculate their wages, because it's going to be significantly different if it's a Schedule C income only with no employees.
And you can see from this, the one thing that we're really stressing to all of our clients is you need to put a plan in place now, because you have 8 weeks to spend this money. You can't go back and correct it after the fact. And so kind of having a plan in place and then adjusting over this time period is the smartest thing to do in order to maximize your loan forgiveness.
Let's go to the next slide here. So let me talk a little bit about the unforgiveness. Say you get to the end of the pay period, you had a reduction in FTEs, or you didn't pay out the full 75%, and say 20, 30, 40% of your loan is not forgivable. You still have a 2-year loan at 1% interest that starts on the date of funding. However, the loan payments aren't even scheduled to be due and payable until 6 months from the date of funding. So say you funded on May 1st, on November 1st, you will have, the bank will tell you basically the amortization period for principal and interest payments over the remainder of the loan. That's pretty important because it gives you actually 6 months to work on making sure you get the full amount forgiven, and then also it will give you some time to plan for cash flow, and you won't have just an immediate loan payment due off at day 1 at the end of the 8-week period. So I think that's going to be a pretty important thing. The one thing that is going to be back into the whole piece of whether we have, I guess I'd say accrued interest. We still don't know yet whether the bank, if say you get to the end of the 8 weeks, you realize you are going to have a piece that's unforgiven and you pay it immediately, Is there going to be accrued interest on that or not? That's one of the things that's still up in the air. Speaking of the unknowns, there are several, and there are some really good articles that we've read. We're part of 2 other mastermind groups of CPAs across the country, and daily we're seeing back and forth of people that don't agree on how the rules are coming into play. The 2 big parties we see right now that aren't agreeing are the IRS and Congress. In fact, a couple of the senators, I think there's 4 or 5 of them, they're bipartisan. Some Republicans, some Democrats have come out and said, we intended for this to be a tax-free loan and tax-free forgiveness to the taxpayers, to the businesses. The IRS last week in their interim rule said that any expenses that are forgiven will not be allowed as deductions, which in theory would reduce your expenses, increasing your taxable income, thus making the forgiveness piece taxable, whether it's income or a reduction of expenses. So we're trying to figure out, what that's going to entail. It sounds like Congress is pretty heavy, as well as the AICPA, American Institute of CPAs, are really pushing to make sure those expenses that are forgiven are also eligible to be deducted on the tax return. A couple of the bigger pieces too here at the top is this proof of economic hardship. Specifically, if you read the law, the taxpayer, the borrower, is supposed to make a certification that they expect or have experienced economic hardship, and this loan is going to be necessary. The round 2 of the loan program that's come out, some of the banks have put in more strict language that requires them to certify and sign off on it. We think that everybody, in theory, has some probably risk of economic hardship, whether it's over this 8-week period or whether it's going to be for the next 6 months or 2 years or whatever. So we feel like the language was broad enough that everybody would have some type of qualification. However, we will be tracking it closely to make sure if they start coming up with something that further defines what qualifies as this, that we will immediately tell all of you and make sure that you're fully aware of it. There is a safe harbor provision that allows people up to next Thursday, May 14th, to return the funds if they're deemed that they don't suffer from an economic hardship. Primarily, we're seeing that they're going after the bigger companies, the ones that receive more than $2 million of funds, or the public companies, or those who have other means to other capital resources. But they're really going after the larger ones, not the people that receive $20,000 or $50,000 or even a couple $100,000. Yes. There's another piece in here, as many of you have heard, the EIDL, Economic Injury Disaster Loan Program that came out, allowed for people to have advances up to $10,000, and it was based on the number of employees you had. That program specifically was supposed to reduce the forgiveness piece of the PPP. So if you got a $100,000 PPP loan and you have $10,000 of advance, the most you'd get forgiven would be $100,000. However, we are seeing that there are some calculations that are saying you can actually have both, but the EIDL advance would reduce the eligible payroll. So if you have, say, a $100,000 loan and you have $120,000 of eligible payroll, that EIDL advance would only reduce your payroll down $10,000. You'd still qualify for full forgiveness. So you would have both the advance and the loan completely forgiven. Those items are still up in the air. We'll as we receive guidance on that, we'll talk about it further. What about the health insurance, Michelle?
The one item with S Corp owner health insurance is for most of the loan applications that I saw, this was able to be included with group term health insurance. However, we just want to kind of put in people's heads that there's a chance that they could include this with wages in the $100,000 maximum, because that's how it's recorded on somebody's W-2. We're just not quite sure how they're going to treat the S Corp owner health insurance in the calculations at this point in time.
I've already talked about that forgiven expenses being tax deductible. We're hoping Congress wins on this one and the IRS loses. But at this point, let's conservatively expect that you may have reduced deductible expenses if you get loan forgiveness. So next steps, how can we help? For a lot of you, we've helped with the process of setting up the loans, getting funding, being able to determine the calculation of full funding amounts. Now is really the important part is being able to qualify for full forgiveness. We have several clients that are part of our monthly maintenance program. We do their accounting and everything. We're helping them as part of this with the ongoing monitoring, making sure that they can plan and strategize properly for how to use the expenses, how to maximize forgiveness, how to maximize their payroll resources, as we showed with that example where, do they hire back a number of people? Do they hire back strategically, some strategic people versus everyone? I mean, how do they do that? And so being able to continue to monitor that, not only over this 8-week period, but then also through calculating forgiveness is going to be the key. We obviously are offering that to any clients, even for those who are listening that are not current clients of our firm. We'd love to help. Contact us. We can kind of give you an idea of what that would look like, what the steps would be, and how we would help. But the key would be monitoring, ongoing, helping make sure it works within their cash flow and running their business, and then also making sure they have the proper documentation when they go to request forgiveness from the bank and the SBA.
One of the main items with having to spend it during this 8-week period is we have been advised that those funds need to clear the bank within that 8-week period. Meaning just because you write a check before this time period is over, there's a chance the bank could come back and say, oh, didn't clear the bank. Having a bank statement that proves that you have spent the funds within the allowed time period is going to be the most solid evidence. Hopefully the banks will use the mailbox rule, use all of the same accounting rules that we have, for cash basis that we always use, but we're just wanting people to be very careful so that everything is allowed.
For example, if your pay period, the 8-week period ends on April 30th, and let's use the example, say you got funded on May 2nd, and you're not going to run your payroll. Your payroll is not going to run again until, say, 2 or 3 days after the period is over. You're going to want to make sure, you may want to actually run your payroll that week, Wednesday instead of Friday, just to make sure it's paid during the pay period, during the 8-week period. So there's going to be some things that we're going to work through here with those who we're working with on the forgiveness piece to just make sure that something doesn't get missed. Michelle, let's go to the next slide here. Little Q&A. One of the items I got a question on from Lee was, how do we calculate or report Schedule C income since it's not considered a wage? On a real high level, your loan amount was based on the 850 seconds of the net income on your 2019 Schedule C. Automatically, regardless if you have any payroll or expenses, 75% of that's going to be forgiven, is what we're currently seeing. Because for a Schedule C person, if you have no net income during that period, then you're fine. So what we would do is take the 75% of the loan amount, plus add in any of the rent, mortgage, utilities, items, and be able to then do a full calculation of what that forgiveness piece will be. So it's kind of a win-win, because say for example you had $75,000 of qualified forgiveness because you had $100,000 Schedule C last year. You're going to automatically get the 75 forgiven even if you have zero income during this period. Plus, you don't have any expenses, so all of it's fully forgiven. There won't be any reduction of deductions on the tax return. So it's kind of a win-win for some of the Schedule Cs. Secondly, we did have a question on how are we going to track the PPP loan money. If we use a separate account, how do we transfer funds? We already have ACH set up. We already have credit cards set up to make the payments. Well, we're thinking is, if you have the ability to set up a separate account on your trial balance in your GL, that would be a great way to allocate those funds that are in there, even if they're not in a separate bank account. And then any expenses, we have some that we can, template that we could share of, if it's easy, set up some other just line items in your P&L to show what those expenses are so that you can track them better. Otherwise, we will be able to go to payroll reports, payroll registers, check copies. We still haven't seen some guidance yet on whether if you pay it on your credit card, is that going to be considered a viable evidence of the payment, or are you going to actually need to show a check paying the credit card expense? But we recommend trying to keep it as separate as possible. If you're one of our clients that we're working with on the monitoring and forgiveness piece, we'll have a spreadsheet that we'll be putting together that we'll be able to track this for you and monitor it on an ongoing basis. So hopefully that'll help. I don't see any other questions that have come through. Jill, do you have any questions?
Not at the moment. We are recording this, and we noticed some of you guys jumped on a little bit late and maybe missed some of the items that you were wanting to hear. Feel free to go back and watch it. We're going to be posting it on our website.
We'll be posting it on the website. We'll be sending it out to the participants, plus those that we're already working with. And then obviously, if some of you you're on this, you're listening to it already, you're going to get a copy of it, but we'll send it out to clients too as they request it. I'm going to stop sharing for a second and let you get a chance to see our smiling faces. We're still here. We don't have to social distance, obviously, but we just want you to know that we're always here for you. We want to have our clients realize that we have your back. We know it's a really tough time. We know that a lot of you are in survival mode right now. A lot of you may be closed down. Some of you may actually be doing better than you were before because the industry and the COVID pointed more customers your direction. We just want you to know that we care about you and we're here to help however we can. We have a great team. You can reach out to any of us, account managers, anybody. Our email, if you want to send a general question, obviously is team@cpataxteam.com. We're going to be posting updates. We actually have a banner on our website. If you go to www.cpataxteam.com, there's a COVID-19 resources banner on there that you can click on, and it'll have various items. I think there's actually some calculators on there too. So
quickly.
Yeah.
One of the last questions we got are 941 deposits okay for reporting? No, because Social Security, Medicare, those are not, the employer portion of that is not, does not qualify as payroll expense. So that's not really going to give the information necessary in order to calculate this qualified payroll.
That's correct.
Thank you.
All right. Well, we're going to stop the webinar now. If you have questions, like we said, you can always email us. We're here to help. Hope you have a great day. Hope you're getting out and getting some sun, and we'll talk to you soon. Thanks.